to our next objective here in chapter 28. And what we're looking at in this particular objective is basically what determines the value of an asset. And again, this is a financial asset that we're talking about. So let me go ahead and share my screen with you. And share screen. This one. Sure. Okay. And let me just pop something up for here so that I don't have to keep going back and forth. Okay, so we're still kind of looking at these basic tools of finance. And here we're going to take a look at, first of all, what determines the value of an asset. And then there'll be a short transition. And I'm going to show you a video I did some time ago that talks about efficient market hypothesis. And I think it's still pertinent. So I went ahead and I'm going to embed that into this. Okay. So when we look at whether or not to buy a stock, we have to take a look at how is the stock performing relative to its market price? And when we say price here, we mean the market price or the stock price. And what we want to try to do is value this stock, the valuation of the stock. And so if the price is if the value is greater than the price, then it's going to be undervalued. And this is what Warren Buffett uses, kind of looking at undervalued stock. If the stock price is greater than the value, then it's going to be overvalued. If they're equal, it's going to be fairly valued. So we're going to go ahead and look at this in the example of using a problem, because I think it works really easily. And we're going to use the present value of formula here. So again, this is kind of why it's in this chapter. If you buy a share of AT&T stock today, your return on investment is 10%. You will be able to sell it in 3 years for $30. You will receive a $1 dividend at the end of each of those 3 years. What is the valuation of the stock today? So what we're going to do is to take a look at, again, present value is equal to the future value times the present value interest factor of the interest rate for the time periods, or if you prefer, the present value is equal to the future value, V over 1 plus the interest rate to the nth power. Okay, so let's go ahead and look at what will happen. So here we have our years, so to speak. So here's year 1, year 2, year 3. Okay, so the amount that you're going to receive, well, it says you're going to get a $1 dividend at the end of each of those years. So we're going to say the amount that you're going to receive in year 1 is going to be $1. Amount in year 2, $1. Year 3, $1. But you're going to sell it at the end of 3 years. So I'll put sale year 3. And that would be $30. Sell it in 3 years for $30. Okay, so what we have to do is we have to take this $1 and find out what is the present value of that. So this would be time period 1. And our interest rate is going to be 10. Okay, or 0.1. So let's see what the present value of $1 1 year from now at 10% for 1 period. So we have, I'll just do it the way your book kind of does it. So we have $1 times the future value. Oh, no, we're trying to find out the present value. Sorry. Well, okay. Sorry, I had to erase that because I was using something that I didn't think was right, and I think it ended up being right. Okay, so we're going to have the present value is equal to the future value is $1 over 1 plus 0.10 to the first power. And that's going to be 1.10. I did the X1. $1 divided by 1. How about 91 cents? Because it's dollar amount, so we're going to round it. Okay, $1 for the second period. So our N here is going to be 2. Our interest rate is going to be 10. And so we're solving for the present value is equal to $1 over 1 plus 0.10 to the second power. So 1.10 to the second power. I have 1.21. At 1 divided by 1. How about 83 cents? It's actually 0.8264, but we're going to round up because it's money. Okay, so we have N. The only thing's changing here is the N. Interest rate 10. Our present value is going to be $1 over 1 plus the interest rate to the third power. And we end up with, I get a factor of 1.3310. So I'm going to store that. And $1 divided by factor is going to be about 75 cents. Okay, we're going to sell it at the end of year 3 for $30. So N here is going to be 30. The interest rate is still going to be 10. We have to solve for our present value, but here we're going to say $30 over 1 plus 0.10 to the third. And that's going to give us about 22.54. Okay. Now what we're going to do is sum all of these up to get the value. So 91 cents plus 83 cents plus 75 cents plus 22.54 is going to be 25.03. So we're going to value the share of AT&T stock at 25.03. Now, what we would do is to take a look at, well, what is the market price right now of a share of AT&T stock? So let's go ahead and look at that and see if our 25.03, our value, are we overvalued, undervalued, or fair valued? So let me erase this for just a moment. So we have 91, 83, 75, 22.54. Right now, this was not that long ago. I think I pulled this on 8/24 of 2023. Notice that our share price is $14, right? 14.14. And that was an after hours trading. So I pulled this from Market Watch. We can kind of see over the year what has happened. So we valued it at, what was it, 25 something. So you can see that this particular share of stock is only trading, its price is at 14.14. So when we looked at our problem, right, and we added all of this up, it's overvalued. Why is it overvalued? Because the price is 14.14, okay, and our value was 25.03. Because our value is greater than our price, the stock is overvalued. And when it's overvalued, you might want to short it, because you know, again, this is where our price is at. It might actually be an opportunity. Again, we're only doing this based upon one sliver of information, and there's a lot more things that go into valuation other than just this. And these are the reasons why. Because it's kind of a problem. We don't know what the future dividends will be. We also don't know all of the information that we should. Again, looking at the fundamental analysis, yeah, we can look at accounting statements, but more so, what's the future in terms of that opportunity, the competitive opportunity for that particular business. And so you really have to do a lot of homework on this to ensure that what you've calculated is actually correct. And again, we don't know what future dividends or prices will be. That's kind of one of the things that is a little unknown. At this point, what we're going to do is go on. I have a little break here, and we're going to go on into, come on. We're going to go on into discussion of the sufficient market hypothesis. Efficient market hypothesis basically says is that all information is already contained in the stock price. If we don't have insider trading, then all information is totally available. But the question I always have is, what levels of information can we get at? So I'm a member of MarketWatch. I pay to do that. Not everybody has that particular edge. So I think that's where some people have better information than others. So I'm going to go ahead and turn it into the efficient market hypothesis, and I'll see you next time. Thanks.
And we're going to take a look at what we call the efficient market hypothesis, discuss a little bit about markets, and kind of how all this works. Okay, so let's go ahead and jump into it. Share my screen with you. Go ahead and start my slideshow. There we are. Okay, so we're going to take a look at the principles underneath a thing called the efficient market hypothesis. I probably shouldn't say principles because they are not principles. The efficient market hypothesis, the lowdown of it is that whatever the stock price is, and you watched me kind of look up a stock price for AT&T earlier. We said it was what, $30.16. Now that $30.16 reflects all, that's the key, publicly available information about the stock price of AT&T. So this means that everything that has been talked about happening with AT&T is open to public awareness. Now, again, each company is closely monitored by money managers, and that's why you kind of hire someone to do this on a full-time basis. So let's just say AT&T was talking about some new technologies. Well, that information about that new technology is already in the stock price, which is published. Therefore, having a tip, inside information, and those things don't happen in the efficient market hypothesis. Now, again, there might be insider trading and illegal things happening, true, but there's no way to corner this market because all of the publicly available information is already in the $30.16. Now, what if you have proprietary information? Well, that's where we get into insider trading. Oddly enough, the Trump administration is being, let me back up. The Environmental Protection Agency is being sued, okay, by another part of the government, which is kind of interesting, the Federal Trade Commission. So there are some issues surrounding this. There is a company which mines in, I believe, Canada, and the EPA was going to allow additional mining, okay? And what happened was, because they thought things were going to go their way, there were some individuals in administration during the Trump administration who acted on that information, bought the stock of the Canadian company, and when they did that, then the EPA released the announcement. So notice the announcement wasn't available to the public. Only a select few were able to get that information. Now, many green movement groups, for lack of a better term, have now asked the Federal Trade Commission to look into the EPA's release of the announcement. And did they leak that announcement to a few in the cabinet who acted on it and bought stock? And if they did, then that is insider trading, which is illegal. So the Federal Trade Commission at this point today has not picked up that case. They don't really want to look into it. They don't want to look into the other arm, okay, of government, which kind of makes sense in a way. In a way, it doesn't. Okay, so when we talk about this is a supply and demand that should be setting the market price. Now, if we believe in the efficient market hypothesis, the first thing we have to resign ourselves to is that there is informational efficiency. Now, what does that mean? It means everyone has the same availability and the same access to information. And based upon everything that we're hearing about, we know there is not a level playing field for anyone. It could be gender, it could be race, it could be ethnicity, it could be living environment, it could be socioeconomic status. All of these things might hinder access. So I have a little trouble with the idea that we all have access to information. Yes, we might have the access, but do we have the knowledge to get to the information that we need? Do we know that we should be following X, Y, or Z? So this is, again, why I trust my money to a full-time person, that's all they do. So the second, again, with this informational efficiency, and the second part of this is rationally reflect. So what do we mean by rational individuals? Well, we mean that a rational individual will do something as long as the benefit of that is greater than the cost. So my question then becomes, does everyone act rationally? So I kind of have a little issue with the idea. But here's the total implication of the efficient market hypothesis is that stock prices should in fact be random. And the only thing that should affect a stock price is information that wasn't publicly available. So a natural disaster, an act of God, something that happened that was totally unforeseen should be the only thing affecting stock prices. Okay, so again, it's an idea, and again, theory. So I love that Mankiw really points out, he's your author, really does point out the idea that this is a theory. Okay, it's not really been proven. It's not completely true because we know that traders, for example, have access to supercomputers, right? And those supercomputers might be able to process information faster. If I can process it faster, then I can get into the market earlier and maybe make more money than someone else. So that's kind of where I'm coming from this. Even if it's not exactly a random walk, it is close. So, okay, if you are following everything you should be following, right? The knowledge, and you're able to see the big picture. One of my favorite shows is Billions, and I like it because it's a bunch of traders, and they're talking a lot about how they see things in the grand scheme. If this happens in this country, and that will impact this, and this will impact this, and so on. And it kind of goes all over all of the things that have to gel together in order to really make good money in the stock market. Now, there's another, how can you kind of get that proprietary knowledge without having the proprietary knowledge? And a lot of people, again, will use an index fund. We talked about index funds, mutual funds. I showed you some examples prior. Now, some funds are actively managed. And again, if you're going to be doing this, it's entirely up to you. But you might have a professional portfolio manager. That's what I have, okay? And they buy only the best stocks based upon your beta risk, based upon your long-term investing goals, and they do tend to look at things more long-term. These, the performance of index funds, because it is not an in and out daily situation. So they're not pulling your money out and pulling your money in at every moment. Interestingly enough, my active portfolio manager only during the coronavirus has been sending out weekly emails to say, don't panic, don't do a panic sell during this time. You know, we structure you for the longer term, and this too will resolve itself. And yes, you've lost a lot of money, but you know what? You're already up a lot of money. So there's some interesting things about this, particularly in the previous objective, we talked about risk. And it's not good to look at your portfolio on a daily basis. It's actually good to look at it maybe once every 6 months, maybe once a year, because you might make decisions that you would regret later on. And we want to try to avoid all of that regret. So active portfolio managers they have a lower return. Okay, so less risk, right? So lower the risk. Okay. They might trade more frequently if they don't have a long-term plan for you. So I think the best thing is to have a manager of your portfolio, and that manager you never really talk to. The person that you talk to is your advisor. Okay. Now, I have an advisor who works with a manager. I never talk to the manager. I trust the advisor that they know what they're doing. One of the things you really have to be careful of, particularly in all of these funds, mutual funds, managers, and so on, are fees. Because if you thought your banking fees were hard to understand, financial investing is 10 times worse. Because when I was doing this, we would charge a front fee, a fee every time we sold something, every time we made a call for something. It's a lot like a lawyer, you know, lots and lots of fees. So, you know, so lots of different fees that we would have. Okay. Again, efficient market hypothesis, what's the big assumption is that people buying and selling stock are rational, because the behavior of a large market maker or several individuals will affect the stock market. So here's a really stupid but great example. When the coronavirus happened, okay, what happened to the price of Corona beer? And is that rational? And we'd say, absolutely not. But the price of Corona beer plummeted. There's no relationship that I know of, but again, so when we talk about stock prices, there is a psychological component to it. We are still irrational beings. And that's why I do love the book by Akerhoff and Schiller that talks about us just really being very developed animals. And we have herd instincts and we follow things. And, you know, I have horses, and it's funny, if a leaf blows across the pasture, one of them will go, oh my gosh, we're going to die. And the other ones are like, I don't know why we're going to die, but we're going to die. And then they're all running all over, being all crazy. And it's just because one saw a leaf out of the corner of their eye, and they've seen leaves so many times. But again, well-developed animals. Okay, so kind of interesting when you think about it. We've already talked about asset valuation, okay, above its fundamental value or overvalued, and we might then be looking at a bubble. And a bubble is it's based upon irrationality it's what demand and supply of people acting in the market is what's driving up the price, okay? So, for example, if I decided to sell all of my shares right now, and I'll just use CSX, then what would happen is, if other people did as well, they saw me selling, now the price is going to go down, and then others are going to sell off, and then the price is going to go down. And that's a lot of what you've seen during the coronavirus in the stock market happening. Again, are there speculative bubbles? Yes. Right now, the ones that we're watching are the student loans, because student loans are bought and sold in the secondary market. And so some economists are predicting that it will go the fate of the housing market. Okay, so kind of the same thing might happen. All right, so again, here's the debate among economists. And this is what we like to talk about when we all get together. Sounds really boring, right? Because it kind of is. You know, what are these departures from rational pricing? Why is this happening? Why are people doing what they're doing, and so on? And again, there's another great book. It's called Irrational Exuberance. And that was a term coined by first John Maynard Keynes, and then Alan Greenspan, who was chairman of the Federal Reserve, talked about irrational exuberance in the market. So it's really hard to explain why people do what they do. And if we all could figure it out, we all would need to work, and there really would be no market, because what would be the point? So impossible to know the correct rational valuation of a company because it really is. We don't have all of the information that we need. And so, okay, so that is the end of chapter 27, this objective. And so I think we have one more chapter in this part, which is chapter 28, unemployment. And then we will be ready for, I think, our third test. And that's over 25, 26, 27, and 28. So thanks for your time, attention. I'll see you back in chapter 28.